seeds rounds have become astronomically large in many ways. So are you doing what you've always done? Are you having to change with the times? How is your VC model looking?
Well, first off, thank you for having me. I think we right now live in a world of giants, both on the venture capital side and the company side. And we've really stuck to our craft, which is early stage investing, backing founders with an idea of raising a few $1 million and looking to build a giant of tomorrow. And we wanted a fund size that allowed us to execute on this strategy where we could be a close partner to these founders. As funds get larger, incentives shift, and they increasingly put larger amounts of capital into later stage rounds, and you see that with Anthropic and OpenAI raising many billions of dollars. We tend to start more at the ground floor and have crafted our fund and our team to be a partner to founders when it's not obvious and before the technology is clear and before the market opportunity is present.
But the size of the seed rounds, even when a product hasn't developed, I mean, you're thinking, what was it, reporting around $2 billion being raised by Thinking Machines Lab. You're thinking about safer superintelligence, again, a $2 billion seed round. I know Ed's going to come in with the avocados and the mangoes, but how do you stick to your knitting? Or you just you ignore those sorts of companies?
No, it's a great question. I think there's a bifurcation in the market. I think there's traditional seed rounds, which are increasingly companies started by younger founders, graduates from Harvard, MIT, Stanford. They're raising what we call a more traditional seed round of between $3 to $5 million. In many cases, they're building on top of foundational model companies. So they're leveraging the technology and the capital invested in OpenAI and Anthropic, and we've backed a number of those companies, and they build on what we call the application layer. On the flip side is exactly the types of rounds you're talking about. It's typically researchers that are spinning out of established model companies. They're raising, in many cases, could be hundreds of millions, could be billions of dollars out of the gate to go and do research and perhaps commercialize a future technology. We've largely avoided those rounds, and those rounds have been led by companies like Andreessen Horowitz and others. We will pick our spots, but in many cases, founders don't really need $500 million out of the gate, though in this capital markets environment, they're able to get it, and there are funds that will back them to do so.
Bennett, before co-founding A-Star, you did 4 years at Co2. And I imagine focused on slightly different scale and domains. But would you just reflect a little bit on the difference in your experience, what that was like investing out of Co2 versus the seed stage at these check sizes and round sizes?
Yeah, it's a great question. I think incentives do matter, and there's a reason that funds increasingly raise larger amounts of money over time. And when they raise larger quantums of capital, they tend to invest at the later stages, and they tend to focus on large dollar deployment. You know, Co2 is a multi-stage fund. They invest venture through public markets. Most of the focus tends to be on the growth stages when there's already clear winners, and you could invest hundreds of millions of dollars in a company and look to earn a multiple on that. You know, where we play at the seed stage, we're investing, typically it starts out at a couple $2 million. We're backing a founder before there's an idea, before there's consensus around a market, and we're working with them to build their business. The beauty of our model is we can actually make venture-type returns, and we can make 100, 200, 300 times our money, but we have to go and find these, incredible opportunities early, and it takes many years for the companies to sort of grow and mature. The other aspect of our model, which is different from Co2, is we'll continue to invest, which we've done in our best companies over time, and be one of the largest shareholders in the cap table. So it'll be much more concentrated with a handful of companies that we hope will go from inception stage to the public markets over a decade or longer.
What Caroline was referring to about coconut rounds, avocado rounds, mango seed rounds is I wrote a column a few months ago that it's pointless saying seed because in some cases the entry level is so high. But you're committed to this $2 to $5 million level. That would counter that the seed market is alive and well and true to its definition.
Look, we're going to play the game in the field. We've modestly grown fund size. We started out with a $300 million fund. We're now in fund 3 with $450 million. So we see inflation in round size, and our goal is to partner with the best founders in Silicon Valley. So we will do what we need to do to accomplish that. That said, it's still rare for founders to raise $100 million out of the gate with no product or prior track record. That is a rare, I would say, circumstance of particularly researchers coming out of labs. Well, we've seen in other cases, for instance, with a company called Decagon, which is one of the leaders in AI customer support. It's one of the killer use cases of AI where you could replace a lot of folks in the call center functions. We co-led a seed round at a $22.5 million valuation. In less than 3 years, the company is valued at nearly $5 billion, and we've invested in every single round and worked with them to build the business. I think there are a number of examples like that where you can do a lot with less capital, and in fact, it forces discipline on the teams and the companies.